right. Hey everyone. Welcome to SSP live stream. It is Monday, March 13th. How are you doing? Holy smokes, so much to cover today. Uh, I apologize. I missed last week. The last 3 weeks actually. One was a holiday. The other one, banks were closed. The market was closed, and last week I was traveling. I was coming back from Florida, and I had 3 flights canceled. 4 day delay. It was just the longest. I was like, is this trip ever going to end? Anyway, I'm home back in the saddle here, and thanks so much for your patience. Stay tuned. There's lots and lots to cover today. So let's get to it. Let me share my screen with you. And we're looking at a market that is not doing too badly today, despite everything. I know we're going to get into the Silicon Valley Bank thing. We're going to get into bank failures. We're going to get into how to avoid things like this for your own portfolio. So we've got the Dow up slightly today. We have the NASDAQ up as well, 1.38%. So this is a little bit of a rally from last week since Friday. Markets were in absolute turmoil, and with the announcement of Silicon Valley Bank. And so there was just a lot happening there. Look at the move on gold today. Whew. If you're buying coins today, you're going to pay a premium from what you paid last time you purchased. But look at silver, up 6.7%. Big move on silver today. So clearly, when there's, shall we say, blood in the streets, challenges in the equity markets, that is when gold and silver perform their best. So we know over the previous, I don't know how many years, I'd say probably at least the last 20, 25 years, these precious metals prices have been suppressed and kept down to these levels. And I've always said, hey, this is a great opportunity to start buying precious metals because they haven't entirely spiked. They haven't had a huge run, although today is a big move. Very seldom do I see a 2.5% move in gold. Very seldom. Silver, we've seen some days like this where it's been up almost 7%, 8%. And all of the big movements I've noticed lately, because I track gold and silver very closely, all of the bigger movements have been in the last 60 days. So very recent term have we seen the movements in these precious metals. 10-year bond dropping. A lot of pressure put on the bond market right now based on what happened. And we've got the Australian ASX 200 index down slightly. So yeah, we're just seeing a lot of activity. I want to share with you some content that I think is interesting, and it might help. It might help frame for you really what's going on in this Silicon Valley Bank deal and the effects that it's having everywhere else. So have a listen.
And Mohammed Al-Arian, Allianz and Gramercy Advisors and president of Queens College, Cambridge. And Mohammed, I'll ask you a question that we brought up at 5 a.m. this morning. Look, this may be a situation where the crisis is averted, but is it mission accomplished?
Well, we've changed the system. I think Roger Altman was absolutely correct in saying that we are now in a different world. Did we need to do all this? I think given the urgency over the weekend and the fact that there was no perfect policy response, we had to make some compromises.
I'll stop him right there. There was a federal, there was a response from the feds, and they basically said we are not bailing out the banks this time. That's what they said. But let's keep listening.
However, it is why we are here that is important, because that gives you insights on where we should be going from here. And we're here, Becky, basically because we had a prolonged period of overly loose monetary policy. policy. When it came to adjusting monetary policy, the Fed did not act fast enough. And then it had to hit on the brakes. And you've heard me say over and over again.
Okay, so listen to what he's saying. An overly loose monetary policy, meaning interest rates were at zero for a very long time, which was helpful for the economy. We saw low unemployment. We saw our federal deficit not anywhere near the trillions of dollars where it is now, because we were manufacturing. We had people working, exporting goods. Now we're just an importer of goods, therefore increasing our deficit. And then he says, then the Fed came in and started raising rates. Well, yeah, 8 times in 1 year is a hugely aggressive stance. And if you recall, just last Tuesday, the chairman of the Federal Reserve, Jerome Powell, said we're going to stick to our 2% inflation number. In order to accomplish that, we need to be more aggressive in raising rates. So we're going to see an additional rates increases this year. And I did the calculations, in order to hit that 2% inflation rate, unemployment's going to have to go to 10.6. That's essentially, and unemployment right now in the U.S. is only at 3.4, something like that. It's going to triple the unemployment rate. Now, when you have people who are unemployed, they're not out spending money, they're on the dole, they're not able to keep money circulating in the economy. I think this is setting us up for, frankly, a disaster in this economy. Interest rates for most homeowners in the U.S. are front end loaded with interest. Very little principal is paid back in the first 7 years. And with the adjustable rate mortgages, 3 and 5 year rates that were issued out before COVID, they were highly attractive because they were close to 1.5–2%. So now when those mortgages start to come due, when they start to renew, we're going to see a huge financial crisis. That it's going to bump up people's payments by several $1,000s a month for being in the exact same home. Okay, let's keep listening.
When you hit the brakes, you risk both economic and financial accidents. And we just lived through a financial accident.
Okay, so is the bigger concern next whether other banks will have similar issues, or is the bigger risk that the Fed's going to have to not raise rates next time around, and that inflation continues to rage on and maybe gets further out of control?
So 3 things. One, it's important to stress depositors should not worry. Your deposits are fine. And there is no need to be trying to move your deposits. I know there's an inclination to do so. I heard what you did, Becky. I know there's an inclination to do so because after all, it's...
Okay, so here's the narrative. Your deposits are fine. No need to move your money. What he's referring to is the FDIC has insurance for cash and cash equivalents. That includes CDs, certificates of deposit, up to $250,000 per financial institution. So if you have $250,000, you're good. You're covered. No worries, right? Anything above that, technically you are not insured for. And that was the big panic this weekend. Janet Yellen came out saying, the Fed is absolutely not going to bail out banks. The depositors will get their $250,000. Well, there were many technology companies in Silicon Valley Bank. In fact, they funded 50% of all technology companies to the tune of 30,000 clients they have. And 87% of those 30,000 customers have over $250,000 with the bank. So there is mass chaos, mass panic this weekend. Companies wondering how they're going to meet payroll this coming Friday, what they were going to do to be able to get their money, and rightfully so, because there was no silver lining, white knight coming through. Like there was nothing on the horizon. It was a clear, we're not going to bail out the bank. Now they came in, they changed their tune last night. And they said, we're gonna switch things up. We're gonna create a new entity that's gonna loan money to these banks to allow them to be solvent, to allow their depositors to get their money out. Which you think, well, yeah, of course. Like when you put cash with the bank, you expect your cash to be there. It's not there. The cash is taken from the financial institution and invested or loaned out. They do something with your money to earn a higher rate of return than what you're earning on the money market. It's phenomenal. It's like, if you think about it, it's almost like a Ponzi scheme. It's so bizarre. So anyway, this is how banks have operated. Now, in 2007, we had a very different scenario play out, which prompted the collapse of banks, and that was those over leverage. You probably remember them, right? They talked about all these mortgages that were over leveraged and could not. There was just nothing underneath them. They didn't have the ability to pay back these loans. So that caused chaos in the financial market, and literally overnight, what happened was real estate, homes, and prices were what's called mark to market, where they go, oh, let's assess and evaluate what your property is really worth, because prior to that in 2007, values were just increasing each and every year exponentially. What does that remind you of? Well, remind you of the last 2 years, which values have increased in real estate exponentially. Why is that? Well, simple, because banks earn higher interest rates on that mortgage because what's the number? 75% of all homeowners have a mortgage. So only 25% of the population own their homes outright. And the numbers in Canada are similar too. The lion's share of investors, of people who live in a home, have a mortgage. And as the values go up, the lenders are earning more money, right? A higher rate of return. The other thing is, as values go up, what goes up? Your property taxes. So there's an issue here too, where property taxes are going up exponentially as well. So it helps the financial institutions to keep raising these prices, raise property values, raise interest rates, because they benefit. As the consumer, the person on the other side of that, there is little or no benefit to that in terms of the rising interest rates. But let's keep listening.
It's better to be safe than sorry. But honestly, there is no risk to your deposits anymore. That's a clear message.
Any deposits above $250,000 or below? Like, would you say that there's no limit to deposits that are insured from here on out?
It is almost impossible now to go back on unlimited deposit guarantee. And you know what? There's a case for them. Deposits are right at the top of the capital structure. They are very different from bonds, from unsecured bonds, from equity. And depositors shouldn't be expected to be able to do the risk assessments that equity holders and bond holders can do. So, I'm actually quite sympathetic. It's not a great way to do it, but I'm quite sympathetic. I wouldn't have gone as far as they did, but I understand why they did. So that's not the case. But however, people are revisiting rightly the value of bank stocks and bank bonds. And then markets have basically voted already that the Fed will now back away from its inflation fight. And that's not good for the long term.
Did you hear what he said? Back away from the inflation fight, meaning they're pulling back on that 50% interest rate rise in March, which the Fed just announced last Tuesday. I don't know if many of you caught that, but Jerome Powell was in front of a congressional committee saying how they're bent on this 2% inflation rate, and their only tool to do that magically is raising interest rates. As we know, rising rates are not of any help to the consumer, to us, right? So he's saying, did you hear him just say at the end? Yeah, and the market is now kind of forcing the Fed's hand to not raise interest rates, certainly not 50 basis points, maybe 25, but that's not good for inflation, right? They keep this narrative going, this not good for inflation. Well, let me take you back to '07 and '08. Interest rates were right where they are now, right where they are. The Fed had gotten the rates right up to where they are. The market collapsed because of the zero collateralized mortgage obligations, the CMOs. And then they brought the rates down to zero for 7 years. They just dropped them, boom, zero for 7 years. But so many people were hurt financially from that drop in the equity markets that many people filed bankruptcy. Many people couldn't buy homes anymore. Like, there was so much happening during that time financially that was really harmful for the average investor. Stock market crashed in '08 as well. That followed the whole bond thing. So what's interesting, hindsight, as they say, is 2020, that if you had the fortitude and the money to invest in stocks at that time, you made a lot of money. Like, I'll never forget that time. I remember I've shared this story openly. I was in my home in North Carolina, and across the screen on CNBC was the headline, "Is the market going to zero?" So you can imagine how hard it was to buy at that moment instead of sell. But I forced myself to buy, got some incredible companies at great prices. And it's just, I mean, I still have those assets to this day. It was phenomenal what happened with that. So there's a lot of things that are throwing us off as an investor. Different scenario leading up to this time. And the scenario, you know, for those of you who've been following me for a couple of years now, I've been saying sell your bonds, sell any mutual fund that has a bond in it, any type of fixed income asset, because as interest rates go up, those values go down. It's an inverse relationship. So that's exactly what happened to Silicon Valley Bank. The creditors, their depositors, excuse me, not creditors, their depositors were saying, "Hey, I want my money out," because there was a little tweet out there saying, "Trouble over at SVB, go get your money out." And they didn't have enough cash to support that, so they had to sell off some of their bonds in their portfolio. Well, they've gone down in value. They lost over $2 billion in that particular portfolio. So you have now a situation, a bank collapsing, Silicon Valley Bank, the first big bank. They were the 16th most collateralized financial institution in the United States, and they're a global bank. They're in London. They're in Canada. They're all over. So you had that collapse. The last one was Wells Fargo in 2008. And then during 2008, they rolled in, these also, because the stock market collapsed, they rolled in, and banks are now just like brokerage firms, with legislation that's happened over the last 40 years. Banks can, sell mutual funds. They can sell these packaged products. They can sell bonds, all this stuff. So huge exposure to fixed income. And that's what dropped the market last week. That's what is dropping the bank stocks today. So now there's what's called mark to market. You're going to hear that term a lot over the next few weeks, because this is what is determining the strength of a bank's balance sheet. Is they mark to market, meaning they look at the assets that a bank has and they say, okay, if we were to sell them off today, what would that value be? What would that value be right now in this very moment? And that's the mark to market scenario, is reassessing valuations when frankly they could have been doing this all along. Maybe it would have been a good time to do it after the 4th interest rate increase, or the 6th. Or why do you wait now? Why now? That's my question. We've always heard, don't put all your eggs in one basket. I'm going to change that phrase to don't put all your money in one bank. The insurance is $250,000. That's it. So if you're, a financial company, if you've, or a personal investor and you have money Spread it among big banks, because that way you are still covered per financial institution. That is the only way that can help you in what's to come in this marketplace, frankly. Don't mean to be scaring anyone, but I need to arm you with an understanding of really what's going on here behind the scenes. This debacle created a new lending arm by the Federal Reserve. So they are lending money to these banks, these financial institutions, at pretty high rates. I mean, there's nothing low about interest rates right now. So the Fed, the very entity, and the Fed is not a governmental, it has nothing to do with the government. It's a private corporation, not even publicly traded, private. So they can do whatever they want to do, right? It's a public corporations that need total transparency. So they're over here privately held. They're putting pressure on banks and brokerage firms to buy their treasury bonds and notes. Remember, we went through that 2 years ago. We heard about it because China stopped buying treasuries. So they had to go somewhere. So they went into these banks and they got kind of tucked away on their balance sheet. And then the Fed, the very issuer of those same bonds, starts raising rates 8 times last year, 2022. Starts raising those rates. So that is collapsing the price of these instruments on their balance sheets. So isn't it interesting that then the Fed comes in and says, hey, don't you worry, we're going to save the day. We're your white knight in shining armor. We're your ray of sun in this dark, stormy night. We're your ray of sun. So we're going to help with this. We're going to give you some short-term loans, right? We're going to put this money out to you, and but you're going to pay for it. This is a loan. This is not a grant. This is not a forgivable type of, you're paying us back, right? So what does that allow to do? The Fed has now become the owner, the receiver. They've taken receivership of the assets of this bank. And I think they just announced Signature Bank is the next one. There was a crypto bank that had some type of fallout too. So we're getting set. They're setting this whole stage up to be the regulator plus the receiver plus ultimately the lender. My friends, this is like fox in the hen house, guarding the hen house scenario that is just mind-blowing, but it's happening. And it's going to continue. Let's keep going. I'd like you to listen to this. This is an interesting thing.
We hear both this morning. Dave, let me start with you. You have skin in the game. In your fund, you had Signature Bank in there. Your thoughts on what the government has done here and what moves you making this morning?
Well, it's as a portfolio manager, I'm surprised I have time to be on TV. I should be taking care of my shareholders, but I think that the issue is that I think Julie laid it out pretty good in talking about the mark-to-market issues. Again, the 2007, 8, 9, 10 was a credit mark-to-market. This is an interest rate mark-to-market, a lot different. It seems to be equally as punishing, but I think you have to accept the fact that you missed it, and you're going to take a hit in the portfolio. And I think I've got a bunch of other.
How do you miss it? These portfolio managers that have been around for a long time. This guy has gray hair on his head. It's like I have to accept the fact that I missed it. I missed it. Oh, rates went up 8 times and bonds are collapsing, and I had lots of that stock and I missed it. How do you miss it? Because Jim Cramer went on Mad Money and said at $450 a share, Silicon Valley Bank is a buy of the decade. You can't make this stuff up, folks. So, and then he's talking about he even said Signature Bank, like he's pimping out these banks because they don't want the price of stock to collapse, because before the announcement on last Wednesday that Silicon Valley Bank had to raise rates, they issued bonuses. So all their upper level management got bonuses. It's the exact same thing that happened in '08. They all got bonuses. These financial mobsters out there that are taking your money. You know, I'm just like, oh, I can't even. It's so maddening what happens, and that's why we have to do our best to really navigate this thing and understand what's happening, because I know you all have been listening. I know you've been selling your bonds over the years, because I've been adamant about it for the last 2 years, saying sell your bonds, sell your fixed income. Don't lock your money into anything like a CD or a GIC or something like that. Just if anything, stay liquid, but mostly buy gold and silver coins, right? I've been talking about this for a long time. And it's days like this where scenarios like this allow for that fox to control the hen house. I mean, have not only access to it, but full on control of it. And it's not going to be pretty, but I'd like you to listen to just another minute of this.
Other names that look very safe, like JP Morgan and Wells Fargo, and they've gotten hit too. So, you know, it's been a tough realization that risk and fear are still very much alive in this marketplace. And I think the electronic nature of the banking system now, people can move money very rapidly. This isn't people lined up outside with their passbooks looking to get $20 out. This is people that are calling, going on the internet and pulling, you know, millions of dollars out very, very quickly. So, you know, this liquidity issue is, I think, bigger than the Fed ever expected.
So I want to speak to that point too, because I've talked to many of you, and we've experienced it too. A lot of difficulty up to this point transferring money. I mean, it's not as easy as he's saying. You don't just move millions of dollars out of a financial institution. If any, you know, like how many times have Stacy and my wife and I have been talking about BMO? The bank is down. Their online portal is down. You can't transfer. If you do, it takes, 48 hours, something crazy like that. So so can you imagine, right? Like how difficult has it been just to move cash around? And I'm not talking millions. I'm talking, maybe 3,000 or 5,000 here or there, versus what just happened. How much more difficult do you think it's going to become? A lot.
I think it's going to be a struggle going forward here to kind of reestablish a sense of liquidity in the system.
Yeah, it definitely feels that way. And Nathan, as is always the case when these kinds of things happen, there are some people who look at it and say, well, we should have seen this coming if you really scrutinized the balance sheet of this particular bank, which leads me to ask, where else are we going to see these kinds of vulnerabilities? Even with this backstop that now we have seen put in place, is there a chance that we could see other financial institutions fail?
Well, hopefully not. And I think David and you both put it pretty well on what drove this issue. But one of the points I want to add to that is that, this is really sort of a crisis of confidence in those institutions. And that while there was a liquidity mismatch, asset liability mismatch, you also had the two banks in question here heavily concentrated in large deposits. As you mentioned early on, the amount of uninsured deposits at SVB was way higher than what you see across the industry. It's not to say that large deposits are bad, but it allowed for the speed of withdrawals to be much higher. The other thing I would mention is that they were so heavily focused on the VC industry, which many of us have talked about over the last few days. But that allowed really for, I think, groupthink to come out as people got concerned.
Okay, so what you're seeing here is purple lines, the actual amount of cash that was in that institution. The blue line, that represents the $250,000 that's insured. So he's saying, this is an anomaly. It's highly unusual. And I will say it probably is, because the concentration of wealth in the technology sphere, they work directly with venture capitalists. They work with technology companies. In fact, I'm going to share with you something that I just got from. Hold on one second here. Just a week ago, 1 week ago, I received, I think you'll find this interesting. All right, where is it? Let me make sure it's still on my desktop here. Yes, there it is. Gmail. Let's get a Gmail here. Gmail. Let's see. Here it is. You're seeing this correctly. This was a correspondence from Derek Barnett to me. Look at the date, March 3rd. This is a bank executive reaching out to me saying, "Hi, Jaden. Hope you're doing well. My name is Derek Barnett. I help lead Silicon Valley Bank's startup banking team in Florida. We love the work you're doing over at Sterling Stockpicker." Yeah, buddy. And, we just want to highlight some of our programs for you. We got 3 years of no-fee banking, wires, ACH, founder-friendly credit products, no personal life. Like, they made this sound so good, right? And I'll bet a week ago, remember this was announced March 10th, this correspondence email was sent to me on March 3rd, okay? March 3rd. And I am certain that they knew over at Silicon Valley Bank that they're in trouble. So they did a last minute push to try to get more cash depositors' money in-house. Now, I found this very offensive, frankly, because it wasn't until last night, Sunday night, in the evening, that the Fed came in and said, "Look, we're going to make everyone whole. All the money you've got with Silicon Valley Bank, you're going to get it back." Isn't that nice of them? Just so nice, yeah. But that only happened last night. Up until then, the narrative was basically, you're screwed. You're only getting your $250,000. So when I looked at this email, when I first got it, my team, many of you know I'm an intuitive, my team said, "Ignore it." That's what I heard when I brought up that email. Just ignore it. I'm like, okay, I can do that. That's easy. Ignore it. Don't give it any energy. Don't look into it. Don't contact them. We're doing just fine. We're with Mercury Bank. And they sent me an email over the weekend. "Hey, all is good. You're insured up to $1 million. They're heavily funded, heavily collateralized. No issues there." So this is what I want to get to. It pays to follow your inner guidance, right? It totally pays. Like if I was just someone going, "Oh yeah, hey, that does sound good. Wow, I can get credit with no personal liability." That's always an amazing thing, right? Never happens in corporations. You always have to sign personally for any liability. So they made this sound very appealing. And I can only imagine companies that would have gotten the same email, reached out, transferred. Maybe they transferred their accounts to them. I don't know, right? Glad we didn't, though. We just steered clear of it. So I just wanted to show you that because I thought it was very interesting. These companies know what they're doing. They absolutely know what's going on, and they have no issues of taking your money and running, right? So wanted to bring let's switch gears a little bit. I've covered the Silicon Valley deal. You're up to speed on it. You know what's going on. I think you have enough information. If someone was talking to you about it, you could chime in, have a great conversation. Banking stocks are going to be under pressure for a while. This is just getting started. It could very well become a domino effect where it just folds like a house of cards. Time will tell. So, all right, let me switch gears. Right now, I am in the upper portal here called Dashboard. So I'm in the dashboard and I was just kind of looking at this and I was like, you know what, where is that silver ray of lining in everything? And it's right here. Your daily gainers, look at these nice Silvercrest metals having a great day, up 11.25%. Equinox Gold up 12.7. So I just wanted to point out, continue to check your dashboard because this is where we highlight all your stocks for you. You're going to see your gainers. You're going to see the stocks that are trending. You're going to see your most actives. Just an awesome place to go if you need a little bit of a boost. And I also want to point out the stock rocket of the day is this lovely company here. Don't want to do that. Here we go. Orasure Technologies. Low risk, 5-star stock, $6.22. Let me tighten the chart up a little bit so we can get all this on here. MFI still good in the 70 range. It just looks like an interesting healthcare stock. Biotech is still going to do well. Healthcare is still doing well. Stick to what you know in this marketplace. You don't know what's on a bank's balance sheet. You have no idea. I think what's going to happen going forward is instead of the bank grilling the customer, okay, show us everything. What are your assets? What are your liabilities? Give us your tax returns. Give us everything you can. I think as a customer, we have to ask the bank, show us your balance sheet, right? Be transparent in this environment. What do you have on your balance sheet? What are you holding? I'm not putting my money with you until I know what you've got, right? What risky investments do you hold? How much of those risky investments on your balance sheet? What % of your deposits are spoken for in underperforming assets? I think a lot of good's going to come from this time. I think there's going to be a lot of uncertainty. The Fed cannot bail out every single bank that goes belly up. Just can't happen. They don't have enough resources. They can't print enough money. It just won't happen. So we're going to have to be very cautious around this time. Invest in things that you know, and just keep following the stock picker because this has given us a lot. We had going into Friday a 3-star on Silicon Valley Bank, 3 stars. So just by the sheer fact that we're saying, look, don't give this much energy. Don't even really, there you go. Silicon Valley Bank, 3 stars. A 3-star stock is not a buy. You wouldn't even consider purchasing it. So keep following what we know works, and that's our software. 5-star rated stocks, right? We posted a quick update here. We are so close on our app, y'all. We're so close. We're just tweaking it a bit to make sure it shows up on all the devices really smartly and it fits in the containers. So that's going to be launched. When we launch that, we're launching it for, I think it's $15 a month in the App Store. Your monthly subscription fee will drop to that price, $15 a month. So it's going to happen automatically for you. You don't have to do anything. We'll do it for you once we get into the App Store. And we're working on changing our software look and feel. That's going to take about 3 months. We've already engaged the team that developed our app. They will be doing this with our guys Don and Eric as well. So I'm looking forward to showing you those updates by summer. What else did I have? Oh, and our podcast launch. So we've got our first two or three, I think 2 episodes out there now. And then every single Monday, we're going to be issuing a new episode. So hope you tune into it. Would love to hear your feedback about the podcast. Had a great interview with Dr. Don Wood. That's been published. He talked about the psychology of investing, what you bring into your mindset and how that affects your mitochondria, how it affects the amount of oxygen that gets to your brain. Like, it was brilliant. And as my wife Stacy said, that's one you want to listen to more than once. I think so too. Would love to hear your feedback. Have a great week.